the source documents and books of original entry. So on one part, we shall be discussing about the source documents, and then on the other side, we shall be talking about the books of original entry. So we start with the source documents. In the process of running the business, we are going to receive or issue some documents as we operate. Once we relate with our customers, we are going to have some documents that we are going to send to our customers. On other occasions, the customers might send some documents back to us. And on the same note, you can have our suppliers sending some documents to us. Also from our part, as the owners of the business, we can send some documents either in soft or in hard copy to our suppliers. So those documents that we are going to receive or issue in the course of running the business, which normally acts as evidence that certain transactions took place, those are the documents we refer as the source documents. What you are going to receive either in your email or you are going to issue as a hard copy, or what you are going to issue out, then it becomes a source document. They are used for tracking transactions, such that every transaction that is going to be entered in the books of accounts, it is going to have actually an evidence that it actually occurred. So these documents, they act as evidence, they act as proof, is what we call the source documents. So some of these source documents are, number one, it is the invoice. An invoice is a document that is normally issued to demand for payment for the goods or services that has already been sold. So the moment you buy goods on credit or you acquire services on credit, the seller of those services will issue you with an invoice. If it is your business that has sold goods on credit to particular customers, then the business will send the invoice to that particular customer or organization. And to that case, therefore, we are going to have two categories of invoices. The first one is what we call the sales invoice. The sales invoice is normally issued when the business sells. And I told you, in this case, when we shall be talking about accounting, we put ourselves in the shoes of the owners of the business. We own a business. So we talk about it from the perspective that this business is ours. So if we sell goods on credit, those who buy those goods, we normally refer to them as debtors. Therefore, we are going to send to them a sales invoice demanding them to pay for the goods already sold to them on credit. It is a document that requests for the payment for the goods already sold on credit. So it is going to contain the details of the goods sold in terms of the category of goods, their quantity, their selling price, and the cumulative amount that is payable. So the sales invoice, it is our business that sends that invoice to the customers. Then number two, we have the purchases invoice, which is now going to be received by the business. We are not going to send it, we are going to receive it because we had purchased goods on credit from the suppliers. So the suppliers will send that invoice to us, and as a business, we are going to receive that invoice, and that invoice demands that we pay for the goods that we bought on credit from those suppliers. Remember the credit suppliers, those who supply goods to you on credit, we normally refer to them as creditors. So it is prepared by the suppliers or creditors and sent to the business to demand for the goods that we bought on credit from them. But generally, an invoice is a document that is sent by the seller to the buyer, demanding or requesting for the payment of goods or services sold on credit to that particular customer. That is a source document. Number two, it is what we call a cash receipt or sale receipt. This now occurs when cash has already been paid in terms of checks or the cash itself. Once a payment is made, a cash receipt is normally issued. Or in this case, if we sell on credit, if we sell by cash, the customer will pay us and then we issue a receipt. If we acquire something on cash, if we pay by cash or by check, the supplier now will issue us with a cash receipt. So this one simply occurs where money has exchanged hands. Where money has exchanged hands, then a cash receipt must be accompanied to prove that the transaction has been paid. The purchasing order, it's a document that is prepared by a potential buyer or by the buyer to authorize for purchase of certain goods or services. If I want to purchase certain goods or certain services, then I must prepare a purchase order. It is going to give the details of the items that I want to buy, and then the seller will provide those goods to the buyer. So it is a request from the buyer to the seller to be supplied with certain goods or services. And in this case, therefore, also you need to know that when it comes to the purchase order, it can either be the local purchase order or the local service order. The local purchase order is when you are requesting for tangible goods. When you are ordering for tangible goods, you prepare a local purchase order. But when you are ordering for services, you are ordering for the cleaning services, you are ordering for security services from another business organization, therefore, you need to prepare a local service order. So the local service order, it is for procuring services, whereas the local purchase order is for procuring the goods, the tangible goods. That is the difference between the two. Then another source document is the delivery note, which is a document that is going to be accompanying the goods as they are being shipped from the supplier to the buyer. So it details the goods that are being shipped in terms of their quantities and also their value. So the delivery note. So what the buyer needs to do the moment he receives the goods together with the delivery note, you compare the details in the delivery note and the details in the purchasing order, so that you find out whether there is any discrepancy. You had ordered for the goods, they have been delivered, and they have been accompanied by the delivery note. You compare now between the purchase order and the delivery note if everything is okay. If everything is okay, then you accept those goods, and the moment you accept those goods, then the invoice will be issued to you. So it accompanies the goods when they are being delivered. Another source document that is commonly used in businesses is the credit note. A credit note, it is issued by the seller to the buyer of the goods or services, actually to correct an overcharge. And this overcharge normally arises as a result of goods returned. If I sold the goods to you worth 100,000, I'm going to issue you with an invoice of 100,000. But later on, if you realize that maybe goods worth 5,000, they had some anomalies, you return them back to me, then the initial invoice of 100,000 is going to be an overcharge. There is an overcharge of 5,000 equivalent to the goods that you have returned. So once you have returned the goods, that simply means that the initial invoice that was issued is supposed to be reduced by the amount equivalent to the value of goods returned. So to do so, therefore, we normally issue the credit note. So it adjusts the outstanding balance, and therefore it gives the correct amount the buyer is supposed to pay after having returned some goods back to the business. That is the credit note. After you have returned some goods back to the business and you have received an invoice for all the consignment, then there is need to issue the credit note, which will correct that overcharge in the initial invoice and give you the correct amount that is supposed to be paid. Then we have a document we call the debit note, which is issued by the buyer to the seller. to actually request that particular seller to send you a credit note. It is used to request for a credit note from the seller after you have realized that there is an overcharge. So you don't wait. If you don't wait for the seller to send you a credit note, you can remind the seller by issuing a debit note. You tell there is an overcharge here. Maybe some of the goods received were damaged, or in other cases, there was an error in preparing the invoice. Maybe there is a mistake, or there was a mistake in the addition of the cumulative amount. You alert the seller by sending a debit note, requesting that particular seller to actually send you a credit note that now is going to capture the correct amount payable. Number 7, source document is what we refer as the statement of account. And a statement of account, it is actually a summary of all the transactions that has taken place between a particular supplier and a particular buyer. Remember, now we are the owners of the business. So we can be able to request the statement of account from our suppliers. At the same time, we can also be requested by our customers to send them the statement of account. The statement of account is simply a summary of all that happened between the two parties for a specific period of time. So if it is between our business and a particular supplier, it is going to detail the total value of goods that we have bought in that duration. That is the total invoices that we have received, the amount of money that we have paid that supplier for that duration, the value of goods that we have returned to that supplier for that period, among other things. So any interaction between me and maybe that supplier is going to be summarized in the statement of account. And therefore, you can even be able to know the outstanding balance. So you can be told that on this date, you bought goods worth 25,000. On this date, you returned goods worth 2,000. On this date, you paid 10,000. On this date, you bought additional goods worth this amount. And then you can be able to get all that information, and then you will be able to compute the outstanding balance to that particular supplier. On the same note, you can be able to issue also a statement of account maybe to a particular customer, which will detail all the transactions that has occurred between you and that customer, and you can be able to compute the outstanding balance out of all those transactions. Then there is a document we call the quotation. The quotation, it is normally a reply from the seller to the buyer after the buyer had sent an inquiry about certain goods or services. I inquired, I had interest of buying certain items. And what I did, I sent maybe an inquiry to that supplier. Do you have this and this and this item? What the seller will do, he will respond to my inquiry by sending me a quotation. A quotation, therefore, will give the details about the prices of those commodities I'm inquiring on, the terms of sale for those goods, and also it forms as a basis for negotiation for potential purchase. So it is a response from the inquiry you, the buyer, had issued to a particular supplier. And then once you get that quotation, you are going to make the decision on whether to buy or not. If you make the decision of buying, then you are going now to send the RPO or RSO, depending on the nature of the product that you want to procure. If it is a service, RSO. If it is goods, tangible goods, RPO. So it is a response to the inquiry. Then we have another source document we refer as the petty cash voucher. In our various organizations, we normally maintain the petty cash, which is meant to be used in the frequent but trivial transactions in the business. The petty cash is meant to actually finance those trivial but frequent transactions in an organization, and therefore, the petty cashier who is in charge of the petty cash, anytime he issues a certain amount of money or spends a certain amount of money from the petty cash. To prove that transaction, the petty cashier will have to prepare a petty cash voucher. And in most cases, these are the transactions that are going to take place, and there is no actually case whereby you can be issued with a receipt. In most of these transactions, receipts are not issued. So because the receipts are not issued, how will you account for the money the petty cashier had been issued to spend? So anytime the petty cashier spends a given amount of money from the petty cash, then those expenditures are normally accounted for by the petty cash voucher. You, the recipient, if I'm the petty cash, I've given you 200 maybe to go and buy some snacks for the staff. If I've given you the 200, then you'll have to sign a voucher for that. To detail that on this date, I gave so and so 200 shillings. The purpose of that was to buy the staff snacks. And then the recipient of the money, the one who was given that money, will have to sign that voucher, and that voucher will be kept as an evidence. If on another date you pay maybe a person for cleaning the offices through the petty cash, that person who receives the money will have to sign another voucher. It is kept. So at the end of the period, if the petty cash is supposed to run for 1 week, at the end of the week, we are going to review all the vouchers that were prepared, and then we compare with the amount that was issued, and then the petty cashier should give us, or should be able to have the balance between what was spent and what was given, so that it can be reimbursed when another week starts. So that is simply what we call the petty cash voucher. And then there is a bank statement. Bank statement is a document that is normally prepared by the bank, and it gives a summary of all the transactions that took place in your bank account in a particular period of time. How much was received, or the receipts, the payments that was made from your account, the charges by the bank that was levied from your account. All that summary is normally captured in the bank statement. So it gives a brief summary of all the transactions that took place in the business bank account for a specific period of time. If you want to request a bank statement, the bank will ask you, you want the bank statement from when to when? So it must be for a specific period of time, maybe from 1st January to 30th of March. Then that period you will get the summary. Then another document, it is the goods received note, which is simply a document that the buyer normally prepares to acknowledge that the goods have been received from the supplier. The moment the goods have been delivered together with the delivery note and I've received them, I'm supposed to reply by sending a GRN to my supplier to inform the supplier that the goods have been received, and therefore they are in good order as per the RPO or RSO, and therefore the invoice can also be sent, or the invoice can also come together with the goods. You acknowledge that, and then you prepare to pay for the goods that you have received. Then lastly, we have the packaging list. Sometimes we call it the packaging sheet, which is a document that is normally prepared and packed in each and every container. So the delivery note, it is going to have a summary of the entire consignment. But the entire consignment can be either, like, for example, 10 cartons. Those 10 cartons will have one delivery note, but in each and every carton, there must be a packaging list. So a packaging list contains the information of specific items that are in that particular container or carton. And then the summary of all the packaging lists, they give now the delivery note. That is it. Actually, we have the last one, which is the check, which is a formal way of making payments through your bank. Instead of using cash, especially when the amount is a bit huge, you just write a check, requesting or ordering your bank to pay a certain amount of money from your account, to a particular person. So it is a formal means of payment for the goods or services. So those are the commonly used source documents. Those are the commonly used source documents. So I don't know, maybe I can review some of the questions that have been tested on this. So there is a document that I've just shared with you. On the past paper question on the source documents and books of original entry. So these are for the old curriculum. Remember, for the new curriculum, we have done like 3 or 4 exams maximum, but they are also tested in your case. Like this one for 2017, explain the purpose of each of the following source documents in accounting. The sales invoice, we said it is used for requesting for the payment from the customers for the goods already delivered to them. The delivery note, we have said it is a document that accompanies the goods when they are being delivered, and it contains the information of the goods that are being delivered. The receipt, that is the same as the cash receipt. It is a document that is issued to act as a proof that either cash has been paid or received. The debit note, it is a formal request to the seller of the goods to correct the overcharge that is in the invoice due to goods damaged or error in the initial invoice. Then we have the price list. We have not talked about it, but you can be able to get a price list. Is simply a document. It is the same as it has the same purpose as a quotation. It is a response to the inquiry. After an inquiry has been made about our product, we can reply by sending a price list, which is a document that contains all the items that we stock together with their prices, so that now our potential customers can be able to decide on whether to buy or not. Let me see. That is it about that. The others is what we are supposed to do on the books of original entry. The books of original entry. So maybe the document is here. Let us run through this and then we do a question. So the books of original entry, as the term suggests, these are documents or books where transactions are originally recorded before being transferred to the ledger accounts. They are books of original entry. Original entry, that is the original point where the transaction is entered. So it is the first point where a transaction is recorded. That's why it is referred to as a book of original entry. And commonly, we refer to them as journals. So when we find that you are told to prepare the journals, those journals are what we refer as the books of original entry. Once the transaction has happened, before we do it or transfer it to the T account or the Reg account, we first record them in the books of original entry or the journals. And these journals, there are actually 6 of them. The first one is what we call the sales journal, which is only meant to record credit sale of goods or services. Credit sales of goods or services. At this point, we know what are goods. Goods are simply stock. When we sell our stock, and that is actually the normal items that we normally deal with in our day-to-day running of the business, what we normally stock and sell. We stock again and sell. Once those items have been sold on credit, then the original point where that transaction should be recorded should be at the sales journal. It should be at the sales journal. So it will capture the date when the credit sale was made, the customer to whom the goods were sold on credit, and the amount or the value of the goods sold on credit. So kindly note, it is going to satisfy 2 conditions: the goods and also credit sale. If it is cash sale, it cannot be recorded here. If it is credit sale, but for non-goods here, I mean fixed assets. If we sell a motor vehicle, if we sell a building, if we sell our land, those are not goods. Those are not the items that we normally stock to sell. So they will not come here. It is only the credit sale of the stock items. Then we have number 2, which is the purchases journal, which records all the credit purchases of goods again. So anytime we acquire goods which is stock on credit from our suppliers, those entries will be made in the purchases journal. It records all the credit purchase of goods. Again, if we purchase a non-stock item in the name of fixed asset, we cannot record it here. If we buy furniture on credit, furniture is not goods, it cannot come here. If we buy goods by cash, again, we cannot record it here. Okay, Margaret will share. If it is a cash purchase, it cannot go to the purchases journal. If it is a credit purchase or fixed asset, don't record it in the purchases journal. Number 3, it is the sales returns journal, also known as return inwards journal. It simply records the goods returned by the customer that were initially sold on credit. So what we sold here on credit, if those customers return them back to us, then they are supposed to be recorded in the sales returns journal. They are supposed to be recorded in the sales returns journal. Goods returned, not fixed assets, goods returned back to the business that were originally sold on credit. Then for the purchases returns, it records goods the business has returned back to the supplier, which were initially acquired on credit from those suppliers. So once we acquire goods on credit from a supplier, and then we realize that they have some issues and we return them back, they become purchases returns to us. Because we had purchased them, we have now returned them, they become purchases returns, and they should be recorded in the purchases returns journal. Number 5 is the cash book. Remember these 4. The first 4, they deal with the credit sale or credit purchase of goods. But now, what if they are bought in cash and sold in cash, not on credit? If they is sold in cash or bought by cash, also including the checks, then the entry will be in the cash book. So a cash book, it records all cash transactions made. all the cash transactions made, they go to the cash book. If you sell goods by cash, they cannot come here in the sales journal. They will go to the cash book. But if you sell them on credit, they cannot go to the cash book. They will go to the sales journal. So you need to know the difference between the two. If you purchase goods on credit, they will go to the purchases journal. But if you purchase goods and you pay for them, either by check or by cash, it goes to the cash book. So cash here simply means cash in hand and cash at bank. Cash at bank, the payments are normally made through checks, and the receipts are also through checks. So anything involving cash and check, they go to the cash book. And we have got 4 types of cash books. The single column cash book, when we were doing the ledger accounts, at one point we used to open the cash account, the bank account. When we operate with them the way they are, cash account separate from the bank account, that is a single column cash book. But for the 2-column cash book, you can combine the cash and bank and operate it as one account, as one big T account. When you fuse or combine the cash and bank accounts together, then it becomes a 2-column cash book. It becomes a 2-column cash book. Then we have the 3-column cash book. The 3-column cash book is an extension of the 2-column cash book. It has the cash and the bank combined, and then we also bring in some element of discount. The cash discounts, the discount allowed and the discount received. So we have the cash bank, discount allowed and discount received. They are now in one account. It becomes a 3-column cash book. Then lastly, we have the petty cash book, which is a cash book that is meant to record trivial transactions. A cash book that is meant to record trivial or those transactions which do not involve significant amount of money. They are very repetitive. They occur frequently in the business, and therefore, instead of congesting our cash book, that is the 2 or 3-column cash book, we normally maintain a separate cash book for them. Those trivial transactions, but they are very frequent in the business. They are recorded in the petty cash book. And then the last journal is known as the general journal. And the general journal, it records now any transaction which does not fit in any of the 5 that we have discussed. It cannot go to the sales journal. A transaction will not go to the purchases journal. It doesn't qualify to go to the sales returns or purchases returns. And also, it does not qualify to go to the cash book. Such a unique transaction will now go to what we call the general journal. And the general journal has got actually 5 uses. It is going to record 5 categories of items. And one of them we have dealt with it. I know you have done, we have done, or it is not actually your class, we have not done ERASA. So it has 5 uses. The general journal is used to record the credit sale of fixed assets. Remember, I have just indicated here that when fixed assets are sold on credit, they don't go to the sales journal because fixed assets are not stock items. They are not goods. So because they are sold on credit, they cannot again go to the cash book. So they will only be recorded in the general journal. If we also purchase those fixed assets on credit, they cannot go to the purchases journal because they are not goods. Therefore, again, they cannot go to the cash book because no cash has been paid. So they are only going to be recorded in the general journal. Also, we are going to use the general journal in correction of errors. We are going to see that. Then also the opening balances are transferred to the general journal together with the closing balances. And the general journal sometimes is known as the journal proper. The journal proper. So you can be told, highlight or explain the uses of the general journal. Those are the uses. Those are the uses. It records those. Now what remains is for me to demonstrate how do we prepare these journals or the books of original entry. Because when the question is asked in an examination, you will be told prepare the relevant journals, or they will tell you prepare this and this and this and this and this journal. So you need to understand if it is the sales journal, how do we prepare it? Purchases journal, how do we do it? And the others plus the cash books. So let me take you through how we prepare them. The first four, they are very easy to prepare. The first four comprises of the sales journal, purchases journal, sales returns, and the purchases returns journals. They are very easy to prepare. You simply need to have 3 columns for each. So, like for example, I say I have my sales journal. If you have a column for the date, the details, and the amount. Then the purchases journal has the same columns. The date, the details, and the amount. The details here, when we are purchasing on credit, the details we capture the name of the supplier, who sold the goods to us, or from whom we purchased the goods on credit. Then the details in the sales journal will capture the name of the customer. Remember, you have sold on credit. You have sold on credit to a particular customer. The name of the customer who or to whom you sold the goods will be captured here in this details column. So the difference is when you sell, details is the name of the customer who bought the goods. When we purchase, the details is the name of the supplier who supplied us with the goods. The same will happen when we have the sales returns. And the purchases returns. So they have the same format. The date details. Here you write the name of the customer returning. Here we write the name of the supplier to whom we have returned the goods. And they are done. So I want us to do one question, and we shall be done with that. So that question number 2. That question number 2 for December 2022, question 5B. The foreign transactions relate to Tausi Enterprises for the month of November 2021. So you are given the transactions and then you are told record the above transactions in the relevant journals. So these are not ledgers. These are now the journals. The journals are the books of original entry. So you are told on November 2nd, bought goods for 45,000 from Temple Traders on credit. When goods are bought on credit, they are recorded in the purchases journal. So we are supposed to go to the purchases journal, 2nd of November. The purchases journal is here. November 2nd. We bought goods from who? From Temple. The amount is 45,000. That's that. That. It is a purchase we bought. When you bought, it's the same as you purchased. We go to the second transaction. Sold goods for 12,000 to Simbuni on credit. When you sell goods on credit, it goes to the sales journal. it goes to the sales journal. So you come here. November 4th, we sold goods to Simbuli, 12,000. That's that. On 8th, returned goods for 12,000 to Kembo. Remember, from Kembo we had bought. On 2nd, we bought goods from Kembo. On 8th, we are returning goods to Kembo. So we are returning what we had purchased. So they become purchases returns. They become purchases returns. So you record it in the purchases returns journal. Purchases returns journal. So you go to your purchases returns journal. You record there that on November 8th, you return goods to Kembo was 12,000. Was 12,000. Then let me do the others now. I hope you can be able to follow, or you can be able to open your documents from your tab. On 12th, sold goods for that 8,000 to Paulo on credit. We sold the goods on credit. That is an entry to be made in the sales journal. On 12th, we sold the goods to Paulo and they are worth 38,000. Done. 18th, bought goods for 66,000 on credit from Twiga. We bought, so we purchased. On 16th, we bought goods from Twiga worth 66,000. Sorry, on 15th, not 16th. Then on 22nd, Paulo returned goods worth 10,000. We had sold goods to Paulo, and Paulo has now returned those goods back to us. The goods that we had sold and they have been returned back, they are now going to be entered in the sales returns. Those are the sales returns. They were sold but now returned. On November 22nd, who returned? Paulo. The value of goods returned, they are worth 10,000. On 26th, returned goods worth 2,400 to Twiga. Those are now, remember we had purchased from Twiga. When we returned back to Twiga, on 26th, they become purchases returns. The value here is 2,400. Lastly, sold goods for 26,000 to Simbuni on credit. This is on 30th. Goods sold to Simbuni again, 26,000. You have done the entries. Then you balance with simply total every journal. The total for this one, because all these goods were sold on credit, they are simply the total credit sales. Here we are going to have the total credit purchases. Zero, 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 one, 1,000. 0, 0, 0, 16, 1, 6,000. So those are total credit sales and total credit purchases. For the sales returns, the total here will be 10,000. That one just says it's the total sales returns. This one will be 14,400. Total credit purchases. you are done. That is what the examiner wanted. You just prepare them like that. But what you need to remember, especially for the sales journal and the purchases journal, never record anything on cash. Never record the acquisition or sale of a fixed asset on credit. Those ones, never record them here. Only for the goods on credit. We are done with the first four. Sales, purchases, sales returns, purchases returns. That is how they are supposed to be prepared. Then now we look at
Excuse.
Yes.
The fourth column, is it total purchase return or it's total purchases, credit purchase or what?
Oh, the total. Thank you. This one is total purchases returns. Yes. Total purchases returns. Eva?
At the end, you said for the first two columns, you don't record cash payments and what?
Sorry, come again?
I'm saying for the first two sales journal and the other one, you said we don't record cash payments and what else?
So remember,
I didn't hear the last part.
The journal and the purchases journal.
Yes.
We said that they only record credit sale of goods. This one records credit purchase of goods. You don't record any cash sale. You don't record any cash purchase. You don't record any sale of fixed asset. You don't record any purchase of fixed asset because they don't qualify. They must be goods and on credit. Fixed assets are not goods. Also, don't record any cash transaction there.
Okay, thank you.
Good. Then now we go to another source, book of original entry, which is the cash book. It only deals with cash transactions. Cash transactions simply means all those items that we either pay by cash or check, or all those transactions where we receive cash or check. So it can either we are receiving cash or checks, or we are issuing cash or checks. Those transactions, they find their way into the cash book because they are involving cash. They are not on credit. And we have got the four types of cash books. The single column, I told you that one we don't do it under the cash book. It was covered when we did the reg accounts. If you look at the reg accounts that we did, or what we did with also Mr. Ezra, we did open a cash account and a bank account. So they are separate. You have your cash account, credit, debit. You also have your bank account. That is the credit, that is the debit. You have them like that. When they are like that, separate, they are single column cash books. When bank account is separate from this is a single column cash book, this is a single column cash book. When they are separate from each other. But in some cases now, we can combine them. Instead of them being separate, we can condense and fuse them into one cash book, which we call the two column cash book. Whereby we are going to have the debit side. And remember, the debit side in the cash book is simply records the cash received or the checks received. And we are going to have the credit side, which simply records the payments. Money out. So you are going to have it like this. On the debit, you have the date, the details, the cash, the bank. We separate with the double lines. Then on this side, you also have the date, the details, the cash, and the bank. So what we have done is combining this. Remember, even here we normally write the date, details. Here we normally use the amount. Date, details, amount. Date, details, amount, and again here date, details, and amount. That is how we do it. But now, instead of having this and this separate, we combine them. We have the date details, the amount on the debit of the cash, that is what we have the cash here. The amount that we have on the debit for the bank, we put it the bank amount. This is the cash amount, the bank amount on the debit. So the debit of cash, it is this one. The debit of bank, it is this one. Then here also we have the date details. The credit of cash amount is recorded here. The credit of the bank amount is recorded here. So we have combined the cash and the bank accounts together to be one ledger account. So it becomes a two-column cash book. So this is a two-column cash book where cash and bank are maintained in one account. And actually the cash book is considered to be both, it is both a ledger, it is both a ledger account and a book of original entry. It is both a ledger account. A ledger account comes to, because it has the debit and credit. A ledger account must have a debit and credit side. So a cash book, because it has a debit and credit side, it is considered to be a ledger account. But at the same time, it is also a book of original entry, or it is a journal. Why? Because this is where all the transactions relating to cash and checks are first recorded. This is the first entry for cash and check transactions. So it is therefore a book of original entry as well. So it serves two purposes, as a ledger account and as a book of original entry. So on this debit side, we know a cash book is like an asset account. Because cash is an asset, bank balance is an asset to you. So the debit side, anytime we have the increase in cash or cash at the bank, we debit because we are receiving that money. We receive cash, cash increases, you debit. You receive check, bank balance increases, you debit bank. You make some payments. Anytime you make payments, you are reducing your cash or your bank balance. If you pay by cash, you reduce your cash, therefore you credit cash. If you pay by check, therefore you reduce your bank balance, you credit the bank. So increase, it is when you receive either cash or check. Decrease is when you are making the payment using cash or check. You credit, and that is all. That is all that you need to do. I want us to demonstrate this using this example here. Tech 2022 question 2B about Kappa traders had the following balances in the month of March 2020. The March 1st balance brought down for the bank is 525,000. Balance brought down for the cash is 130,000. Those are the opening balances. Remember, the business is a going concern. It continues operating from one month to the other. We close this month, we open a new month. So when we were opening the month of March, or starting the month of March, we had a balance in the bank of 525,000. We have the cash box balance of 130,000. And then during that month, those transactions happened. We bought goods by cash. Remember, in the cash book, we only focus on one thing. Is it cash received or cash spent? Let us not get confused by anything. We are not doing double entry here. We are not doing ledger account. Our focus is only on how the cash book will be affected, how the cash or bank will be affected. Is it going to increase or reduce? Nothing else. Just focus on the cash book, cash and the bank. Every transaction, just ask yourself, is it going to increase the cash balance or reduce the cash balance? Increase the bank balance or reduce the bank balance? That should be only your focus. So when you buy goods by cash, it simply means that you are spending cash. So cash is reducing. You credit cash. You sell goods by cash. It simply means that you are receiving cash from the sale of goods. So cash is increasing. You debit cash. You pay electricity by check, meaning that you are spending your bank balance. So bank balance is reducing. You credit bank. You sold goods and received payment by check. Then it simply means that we have received a check which we shall deposit in our bank, so the bank balance will increase. Therefore, we debit bank. Paid rent by check, so you are spending your bank balance, which will be reducing, you credit the bank. You receive a check for dividends, it increases your bank balance, you debit bank. You receive interest by cash, it increases your cash, you debit cash. Paid insurance by check, it reduces our bank balance, we credit bank. That is all. But now, let us now do it practically here. The opening balances should always be the first one to be recorded. The opening balances, the balances broke down. So you'll come here and do this. Those opening balances, this is 2020. This is the first one is March 1. The balance brought down, balance BD. The cash we are told is 130,000. The starting balance 525,000 for the bank. So the cash amount you put it in the column of cash. The bank amount you put it in the column of the bank. Then on that, both goods. When you buy goods, this is now March 3rd. When you buy goods, you normally regard them as what? Purchases. Goods bought. We normally call them purchases. And we paid by cash, so you credit cash. So 25,000, you put it under cash column on the credit side. Sold goods by cash, that is on 7th. When you sell, you receive. So it is a receipt in cash or check. And when you sell goods, you normally refer to them as sales. How much was received? 65,000 in cash. 65,000 in cash, like that. So you debit cash. It is a receipt in cash, debit side, cash column. On 8th, we paid electricity. So you write here what we paid. Electricity, how much is that? 36,800 by check. So you credit bank. 36,800, you credit your bank like that. On 13th, we sold goods and received payment by check. So it is a sales. We receive a check, the check will be increase the bank balance 708 in debit bank because it is a receipt in the bank. Paid rent on 15th, you write here, we paid rent by check. So you credit bank. It reduces the bank balance, you credit bank because we paid by check. On 16th, we are told that we received dividends by check. So it will increase the bank balance, 78,000. Received interest on 24th. and you are told this interest was received in cash, so you debit the cash, 26,000. 28, it is a payment. We are told that we paid insurance, and it was paid by check, 316,000. That is it. Prepare the cash book for that month. So that is how it is done. But for the cash book, you need to balance, because we said it's a ledger account. Ledger accounts are normally balanced. So you compare the cash on this side and the cash on this side. The cash that we have here, it is the total cash received. This is the total cash that we received. The cash that we have here is the total cash payment. So this is the total cash we received. You minus the total cash that we paid, you get the cash balance by the end of March. So as at that end of March, you need to compute the closing balance. The closing balance is always indicated as balance carried down. Balance broke down is the opening. Always note that. CD, it is carried down. BD is brought down. Opening balance, when it is now at the end, we put it as a carried down. So let us do the balancing. How much cash did we receive? We do the total. 130,000 was the opening balance. Then we received 65,000 from sales. Then we received 26,000 from interest. The total cash that we received, therefore, it is 221,000. Out of that, we spent 25. So out of the cash received, let us minus 25,000. We get that the cash balance is 196,000. If you add now this side, we also need 221,000. That is all in cash. You do the same to the bank. You add the total amount that was received and deposited as checks in the bank. So the increase in the bank balance, 525,000 was the starting amount. Then we added 708,000 from sales. Then we added 78,000 from dividends. So the total amount that was received is 1,311,000. That is what we received in our bank. But that amount of money was also spent. So how much did we spend? So we minus the cash from bank that was spent to pay electricity, to pay rent, and to pay insurance. So after spending those amounts, how much is our closing balance in the bank? So we shall minus those payments. 800. You get 8, that is 200. And once you have inserted that balance, the total here will be the same as this. So the cash total on this side should be the same as this. The difference is the balance. The bank total on this side should be the same as that. The difference is the balance. But for the bank, you can have a negative balance. Sometimes the bank on the payment side can exceed the bank column on the debit side. It is possible for the bank, but for the cash, it is not possible. When the payments in the bank exceed the receipts in the bank, that is when we recognize an overdraft. That is when we realize an overdraft. For the bank, it is possible to have an overdraft, but for the cash, we cannot have an overdraft. The minimum cash balance can go is 0. Cash cannot go to negative. There is no way you can spend more than what you have in cash. But for the bank, it is possible. So when this side exceeds this side, you find that the bank balance carried down will come here. Will come here. It is an overdraft. It is possible. So when you witness such kind of a case, don't feel like you have done something wrong. It is possible for that. But for the cash, the balance carried down will always come to this side. And under rare circumstances, this side can be equal to this side, but very rare. There must be a balance to make the two sides agree. Do you have a question? We still need to do the 3-column cash book and also the petty cash book. But I feel like we cannot be able to do a question using
Hello.
the minutes. Yeah?
Hello.
Hello, Wangari.
Are you going to bring balance board down on the other side?
Yes, you can, no harm. That is now when we are starting the new month. Remember, this one was for the month of March. Eh? When we start the new month of April, so you see now the new month, we are going to have the balance brought down. Eh? When we have now April 1, we are going to have now the balance brought down. What we close to is 196,838,300. But now, that is now when we are starting now the cash book for April. This balance will go here. It is going to replace it. And then we continue with the transactions of April. So that is it. My number for those who have not yet joined the WhatsApp. Send that number. Then you can request on WhatsApp. I share with you the link. If you have not joined the WhatsApp group for the class, you can save that number. Then just request me on WhatsApp to share with you the link. I will do so. Now, having said that, now we will stop there. And then Ivy has also shared the link there. You can as well join using that link. There's the link that has just been shared on the charts.